Good morning, everyone. Thank you very much, Gary, and thank you very much, Mark, for setting the stage for us this morning. So just a quick introduction to our esteemed panelists. So Mark, you already did the introduction for yourself, so thank you. Victor is here as the Senior Data Officer for JUDI.AI. We have Becky, who's the ABD for Analytics at Equifax, and Vahan, who's the Director of Data Science at Capital One. So before we begin, I thought I would just kind of set the stage in regards to data as a whole. So they say about 90% of the data that's available today has only been created in the last 2 years, and apparently that's only going to be expedited moving forward. So just goes to show the magnitude, the impact, and potential of data. So Mark, maybe you can kick us off by just kind of determining the differences in lending between traditional and a modern borrower.
I think what we think defines the modern borrower is a desire for immediacy, right? A transformational user experience. And if you work backwards from that, you know, the days of wanting to apply for a loan or a new financial product and having to physically talk to a human, whether it's on the phone or in the branch, having to wait hours, days, weeks for a decision, I think the willingness of the modern borrower to put up with that is low now. What that does is it puts tremendous pressure on us to use data, alternate data in particular, or all the data, frankly, we have available to us to make that decision algorithmically and quickly so that the experience is as near real time as possible for the borrower.
Okay, fantastic. I know demographics have changed so much, but obviously lending has not. So we'll go over to Becky next. And Becky, maybe you can touch on a little bit where, you know, traditional risk models maybe fail for consumers who are small business owners.
Yeah, sure, absolutely. So if you think about some of the traditional credit risk models that we might use today in the consumer space, we tend to focus on a few areas. So, for example, we might be looking at the payment history of a consumer, we might be looking at their utilization on things like credit cards, and I guess some of the newer models are actually looking at the trends of those things. So how are those things changing over time? I guess some of the challenges for small businesses is that some of those behaviours aren't as standard or typical. So if you take myself, looking at my payment behaviour, I get paid a salary every 2 weeks. I will pay my credit card probably every 2 weeks. My mortgage is paid every 2 weeks. It's very stable behaviour. Whereas someone like my husband who runs his own business, he actually has a DJ business, he kind of earns money May to October, and the rest of the year, he kind of doesn't earn much at all, much to my dismay, to be honest. So kind of in the winter months, his credit card, he still has expenditure, he still has advertising costs, so his utilisation on the credit card is going up. Whereas in the summer months, he's paying off those debts. So depending on when he would be applying for lending potentially, it could look good or bad from the kind of traditional credit risk models. So I think kind of what we need to do going forward is we need to really think about how do we better adjust some of our modelling techniques to kind of pick up some of those nuances across different businesses and also in different macroeconomic environments.
Perfect. Yeah, thank you for that great example. I think we hear a lot about the gig economy, so how are we accommodating for those types of workers, right? So Victor, you work at JUDI.AI, so as a new age lender, how would you describe the modern day customer journey?
Yeah, in my case, when I think about modern, or maybe almost everybody will think about the digital experience and also the Amazon experience. Like if you're looking for a product nowadays, you just go online and you're a few clicks away from finding it, paying for it, and then you get it into your door a few days after. So the thing is that's become the standard. Right, so that's what everybody's expecting from every other company out there, and you do that. You don't need to have you don't need to be 9 to 5. You don't need to be in a location. You don't need to travel. You don't need to talk to a person. You just do all of that from the comfort of your home, any time of the day. So and that's the norm, that's the new norm. In terms of the lending space, particularly small business, and I see it a bit from the other way around. So the way of solving the business problem. So the business problem is 100,000 loans costs almost the same as a 1 million loan once you put out there. the difference is that return of investment is really different. So it's costly. And so in order to make the business work, what we need high volumes, automation, data-driven decisions, and immediacy. That's what we need to do. And once we figure that out from the business perspective, at the same time, we're solving the customer journey as well. Because now they're going to get all these platforms, and that's already happening. For example, for us, it's already happening right now, where the customer can go online, fill some data, automatically the platform go out there, brings all the data needed, and makes an automated decision. And then in a few seconds or minutes, let's say, you get a decision out there. That's like how connected these two things are. Once you're solving the business problem, you're solving the customer journey at the same time.
Perfect, thank you. So, Vahan, over at Capital One, you guys have been doing some interesting things. Maybe let's talk about some potential use cases there. What are some key learnings that we could leverage, and how has success and adoption been so far?
So kind of building on a lot of the previous points, I guess there's two kind of main use cases I focus on. One is, given they're already on book, how do you service that account? How do you continue to engage that customer? And how do you provide compelling and relevant experiences when they matter? And so the biggest lever there is probably really building that technological speed and sophistication to be able to ingest real-time data and really optimize those experiences. So that could be things like line management, decisions on real-time authorizations. This up until very recently used to be kind of a batch kind of world where you'd run batch models, batch campaigns, and so there's really untold opportunities to meet the expectations of the modern borrower. Then on the side of just, adjudication, getting them on book, you also really need to appreciate the differences in the modern borrower. And the way I frame this in my mind is, for credit risk especially, these aren't causal models. And why that matters is we rely on consistent correlations. So the bet you're making is whatever you can't observe, whatever information you don't have, all that needs to stay consistent. But they haven't stayed consistent. A similar looking credit file has multiple paths to it. So you layer on generational differences, you layer on the gig economy, and you can't really rely on what things used to mean. So my people, for instance, the millennials, we tend to stay at home for a long period of time. I was there until my late 20s. In some ways, I wish I still was home, but I did have to grow up. And I was also a bit of a thin file, but the reasons why that was are different than why they used to be. And so I was still very credit worthy. Although in retrospect, it's probably because I wear dark colored glasses.
Yeah, no, great insights. Thank you for that. Mark, I'm just going to go back over to you. So as an end user, whether you're a consumer or a business, how does the UX experience and product design differ for a Modernday lender?
I don't know, I think UX is now everything, right? So think of all of us and the products and services that we gravitate towards, right? The ones that capture our attention and capture our time. They tend to be frictionless onboarding experiences, and then they tend to be very sticky and engaging over time. And I think when we think about user experience design, we think about frictionless onboarding and compelling reasons to stay, right? And I think when a number of us sort of took a look at the SMB lending space in particular, and we sort of came in with this thesis that it was well behind the curve in consumer financial services innovation. So the innovation that's not only been happening in our bigger banks, but the innovation that is coming from the neobanks and so on. It felt like it was a really interesting opportunity. And so, and small business lending tends to lag consumer innovation, typically, right, generally. Banks put their time and their attention on the most people, and then they get around to the businesses later. So to me, UX is everything. And so we actually start by modeling the user experience of our new apps first, before we write a line of code. So we have mapped out, for example, for our new product, almost the entire user experience of that product already. And then we will build it based on that framework. But those two elements are critically important. Frictionless onboarding and some sort of compelling engagement.
Yeah, no, I love that. That just enhances the overall client experience. Victor, I'm just going to go back over to you. So the depth of data coverage for businesses may be lower than the consumer, as we've alluded to earlier. So what alternative data sources are you currently looking at in your space?
Yeah, so I think it's the one thing that we look is a lot of on the traditional, let's say, first things, like, you go to the credit bureaus and you have data there that to start. Like a lot of the cases, and this is one of the main challenges in small businesses, that they're really new businesses and they haven't been running for a long time. So it's very common to find thin files or no hits, for example, once you're getting that traditional, let's say, lending data sources. Even though that we've seen that there have been improving lately in 18 years as part of their business model is to just have more coverage. But here's where the alternative data actually gets very, very important. We use it in both ways. We use it to leverage what, once we have a hit and we have information, we still use alternative data, but also it becomes key when we don't have that information. And then the alternative data that we're looking at, some of them are like bank statements, and this is online real-time data that we get, and we'll spend a lot of time and effort processing that and extracting the information from there. We have built engines inside that categorizes the transaction, uses RIP, and also creates a bunch of different cash flows and variables from there and risk indicators. We're also looking at accounting data, so that's another thing that we're looking at. We're looking at taxes information, and we have tried also different things to be a bit more creative, let's say. We're looking at content from web pages and stuff, but those things are more into, I don't know, incubation right now, but this is a bit of what we're doing on our side.
Yeah, no, thank you. I think that's probably the most common question that we get from, especially small business lenders, right? Just because there's so many new businesses, so what alternative data sources are available for them to assess their creditworthiness? Keeping with alternative data, Becky, maybe we'll just have you comment on some of the considerations that are in regards to ingestion and stability.
Sure. So I think the first thing is really how you plan to use that data and kind of where do you see the value as it's coming into your business. And that's kind of really important just because you need to know how you're going to use it, and are there any constraints or regulatory elements that you need to be considering as you kind of bring it in. There's also kind of key and linking elements to it, so some of these data sources may not have the traditional keys or ways in terms of how you actually are going to combine it with the data you already have within your organisation. And I think one that doesn't get talked about too much is actually bias in these data sets. So we talk an awful lot about modelling bias, but actually data can have inherent biases, and as you bring them in, do you know what those biases could be? So an example of, on the alternative data side, you might have things like shipping information. So say I am a small business owner and I'm using Canada Post to kind of post out some of the products that I'm selling. You could look at the volumes of those and potentially use that to track, is that business doing well or not? But what if that business then decides to bring in a second supplier for a portion of that? So you see it drop off, and you don't know why it's dropped off. You might assume that business is doing something poorly, or it could be failing. In actual fact, it could just be some bias that you don't know about because you're not seeing the full picture. So I think that's really important to try and consider as you're kind of using some of these data sources.
Vahan, did you have any other considerations you want to add?
Yeah, I worry a lot about this. I mean, I'd already touched on the risk from these not being really causal models, and so you can't really understand why things change, and when you're ingesting things that are subject to change, then that just only increases the risk. In terms of the legality front, that also does concern me quite a bit. Consider the example of, let's say, you're trying to acquire people through TikTok, because it's relevant with kids these days. And what does TikTok mean? Well, apart from helping people round out China's social data set, it also hypercorrelates with age. And so consider the case where you had a special credit policy for TikTok. You're essentially discriminating on age, and that's a fair lending infraction, that's a human rights code infraction. And so, maybe in this contract example, it's not a real risk. We obviously overlay judgment and we catch something as trivial as this, but with how easy it is to build machine learning models and deploy them, and the scale at which you can ingest mass amounts of data, it only increases the risk that these things slip between the cracks, and that without proper scrutiny of the thousands of attributes you're ingesting, some things, again, through no fault of your own, without malicious intent, really kind of proxy protected things.
Awesome. Was not expecting you to reference TikTok early.
TikTok is very scary.
But Becky, I think the point you made about the bias is absolutely important, so agreed there. So just talking about general challenges using alternative data, maybe Mark, we'll start with you.
Look, I think this is a very good point that was just raised because this is a brave new world. And it's very important for all of us to, as we build our models, look for incremental improvements in Gini and scoreability and whatever, but not to the extent that we over-rely on the shiny object in the room. Because it's quite possible that we will get some sort of contraindicator, and it's even more possible, I think, today that we will run afoul of fair lending legislation or consumer protection, data protection, or other legislation. So I think you have to be very, very careful of it. I think what we see a healthy contention, if you want, internally between a core set of models that we use in the algorithms as our primary decision-making elements, and a hunger to just keep expanding the boundaries of what correlation we might find elsewhere. And I think, so we will always have kind of an inside the fence and an outside the fence model where we're certainly looking to move the fence, but we are going to make decisions heavily on stuff we trust and we believe is defensible and explainable, but we will never stop being hungry for just experimenting with what's out there. And I think the big change that's happened in the last few years is data is becoming exponentially more available. The machine learning algorithms, models, and so on are becoming better at not having to spend a lot of human time trying to look for these correlations. So that in a way, that forces us to keep looking, but we still have to have a chief risk officer and a chief legal officer who are going to take a look at this stuff, and a chief compliance officer and go, you know what, that's not defensible. It may be interesting, it may be helpful, but it's not core.
Absolutely. Victor, were there any other challenges or risks that you wanted to add to?
Yeah, so I see it also in two other areas. So one is security. So first, you need to ingest this data, but you have to keep it in a secure environment, not like all protected behind walls and so on. So we know how sensitive this topic is once your data might be in danger out there. The other thing is consistency. That's another factor that comes to play, is that you're going to be relying to make decisions based on this data that you're going to get. And sometimes this data is you have to kind of, when you're running your models, or you're training your algorithms, you have to look for scenarios like what is enough in this data. For example, what is the minimum that you need to get a reliable decision made out of it? And those are things to me that are challenging in once as a practitioner. I see it on a day-to-day basis, and also this bias. To me, this bias is very, very hard to manage. It's very hard to see. Like sometimes you might be finding some correlations, and those are the obvious correlations, but what about the ones that are not so obvious? Like, and still there. Like, there might be an active variable that you don't think is directly correlated to a bias, but it is. And those things are pretty challenging. I mean, it's hard to see. I think these are the three areas that I see challenges with alternative data in general.
Okay, awesome. Yeah, can't emphasize the security component enough. So if we transition over to technology, because each of our panelists has a diverse background and type of business, so maybe we'll just start with Mark first and just talk about general opportunities and challenges using, algorithms, AI, automation, etc.
Actually, I think at BFS we have a bit of a different challenge in the sense that we're taking a company that historically has never been kind of algorithmically driven and turning it into a company that is algorithmically driven. So probably our number one challenge is seeding that company with the kinds of people who can enable that transformation. Right? So we have a super head of data science in the room here today who we just hired, and he's building a team around him to really pursue that next generation. So frankly, human capital is one of our biggest challenges. And I think human capital probably is going to be all of our challenges over the next little while. I think the other thing is that, I joke that our kind of North Star is, a high genie with no humans. But in reality, there's always a need for, at least for the foreseeable future in our core business, a need for human underwriters. Why? Because sometimes you have to make a subjective decision. And machines are not great at making subjective decisions, right? And the subjective decision sometimes is made based on the soft stuff that comes out of the merchant interview. And we don't see that going away for our bigger loans in the near term. I think what we've tried to do, though, is to set a roadmap for our team that says, in order to deliver a transformational user experience, what do we need to do to underwrite brutally quickly and in a frictionless environment, right? And how do we prioritize the work we do to get there faster? And so I think that's what guides us. We're building an entirely new product here in Toronto, which is unlike anything BFS has ever done. And that new product is being built from the ground up with a vision for what the new reality is, not the old reality. But human capital is our number one challenge, for sure.
Thank you. Victor?
Yeah, the way I see it is that there is tremendous opportunity right now. So that as we're leveraging more and more data, this is one side of the equation, but the other side is the technology itself, the algorithm being used. And the way I see it is that we've been using almost algorithms that have been there for so many years. They haven't been changed, literally. They're just linear regressions. Like, think about that. That's 99% of the cases. So if you think how much data science have evolved since then, like, we have so many new techniques, so many new algorithms out there that we know are way better than what is currently in place in majority of industry companies out there. I see it as a tremendous opportunity. So the thing is, how can we get those algorithms built in a way that we can explain it? For example, we can, and this is a bit about explainability. It's like, how can we use them but understand what is going inside to be able to explain the decisions made? I think because of the regulatory environment that we are, but the algorithm is not there. It's just a tremendous amount of opportunity at this point.
Just sometimes the new data is not going to necessarily help make the decision for you, but it might indicate where to look more deeply. Right? So sometimes we'll see something and we'll go, I can't use that to make a decision, but that's a really interesting piece of data. We should learn more about what's going on, right? And what does that imply about what we might be missing?
Yeah, my approach is I will look at anything that could be correlated first, and then later on we start filtering things out. But I will look at anything that could be correlated.
So if I can just add to that, I think the interesting thing when you talk about kind of the human element and that part of looking and seeing what it's actually telling you, one of the challenges when you're trying to hire the data scientist that I find personally is that it's as much of an art as it is a science. It's not, I interview lots of people with great maths degrees and they understand all the very technical elements of it, but actually being able to see that this is a correlation, it doesn't make sense, but actually let's find something else. That's an art form in itself, and that's where I kind of find the biggest struggle when you're trying to hire people, in the sense of do they think like that and do kind of come with that approach.
I'm good.
Okay, well, I have another question for you, Vahan. When it comes to selecting your data attributes, what are some of the variables that you would consider?
Yeah, I mean, it could be generally framed as balancing performance and risk. So, as you mentioned, consider everything, sure. Ruthlessly go after performance and improvement in your model, but don't lose sight of all the potential regulatory risks you're creating, all of the stability risks you're inheriting, again, as related to shiny new objects that might not mean what they mean one day to the next. And then really being buttoned up on that. And another thing to consider about is, I'm a model risk officer. I oversee kind of the risk in developing and deploying the ongoing risk management models. And so you really got to worry about really what incremental risk are you creating with the model. So for instance, with machine learning models, one thing that we kind of created, a problem we created for ourselves is how much we anthropomorphize these models by calling them neural networks. They don't work the way you think they work. And we've all seen those examples of in image recognition, adversarial systems could change 1 pixel, and what is obviously a cat to humans and continues to look like a cat to humans is not classified as guacamole with 100% confidence. So that's a challenge, and who knows why that's the case. But when you have that much variability in a model, even if your inputs are pristine, even if your performance is fantastic, there's another liability you have to worry about. So we really do obsess with the inputs that are there, exactly how these inputs influence the outputs, and we throw everything in the kitchen sink at gaming these things, stress testing them, varying them, trying to attack the system to see if we can find out the areas of instability. And then of course you have to monitor this thing obsessively.
I think there's also a piece which is, as you make these models more and more complex, you have to still be able to implement them in the real world. So you need to be able to use them in a way that's efficient, that's kind of got real time, that's making those quick decisions. So there's also that element of, can your systems handle them? So you can build the best model in the world, but if you can't implement them, it's not much use to you. So I think some of the kind of new age lenders probably at a bit of an advantage in this space, just because they probably have newer tech and probably some of the newer technology. If you're more traditional lender, potentially that could be a bit harder to kind of make those changes in terms of what you need on the technology side.
You also have to explain and defend the model, right? Which is, I think that's a huge challenge, right? Because I think we're probably ahead of regulators in many respects, and we're testing kind of uncharted water here, and I think that's a huge risk for us.
Some of that, I think, is also the use of the models. So certain models you need that explainability, certain models you potentially could get away with less explainability. It depends on the use.
The one thing that is happening in data science is that all these things are kind of pushing data science back, like to move forward actually, to basically get better at explaining what it's doing. So the pressure is there on data science as well, and we can see that explainability is becoming really, really a big theme in any data science conference or anything that we see, and there is a lot of work being done in that direction. So I see that's also something that will be evolving with time and getting better as well. So.
Yeah, no, absolutely. I think to sum it up, just the storytelling element of it and the education to build awareness is just so critical as we move forward. So when we look at lenders in the general lending ecosystem, and then we have the modern lending ecosystem, Mark, maybe we'll start with you. What would you say some of the key value drivers are?
Value drivers for traditional lenders?
Modern.
For modern lenders? I think it depends on the sector that you're focusing on, but thematically, I think there remain some significantly untapped potential in areas where historically old scoring techniques, the cost of servicing, et cetera, have made it difficult to serve. Whether it's 2.5 billion financially underserved in the world, 700 million aspirational near prime in the world, or whether it's the 71% of small business owners in the United States, for example, who claim that they don't get the credit they need. To me, we see the value drivers in not going after the market that Amazon and Shopify and Square are going to be able to win, but going after the markets that unlock, for the first time, people accessing credit, getting them early in their credit cycle, following them up their credit cycle, and in effect, kind of an undiscovered country, if you want to use that analogy. That for alternate lenders is probably one of the key value drivers.
And I think you also at BFS have mentioned the specialization component as well, right? So whether it's healthcare or so forth.
Yeah, so one of the things we think about in data in particular is if we look at a sector-specific loan, is there sector-specific data that we can tap into that augments the model? So for example, if we were going to lend to dentists across the United States, and we were able to build a relationship with a provider of dental software in the United States, one or two of the big SaaS vendors that provide it, and get access not only to all the historical records of those dentists, but all their future bookings are anonymized and so on. That would give us unique insights into the scoreability and loadability of those particular dentists, right? So if you have a stable and growing practice and you've shown that you're economically successful and powerful, I'd love to tap into that proprietary data. So better data ingestion capabilities, modeling capabilities, reducing the cost of adding new data sets, rationalizing them, addressing them, being able to plug into proprietary data, yeah, I agree, that's a huge value driver.
No, awesome, great example. Becky, anything you wanted to add from your end?
No.
Okay, since we're almost at time, just one final question for each of our panelists, and I always like asking this one. So moving forward, what is your prediction for new age lending for the modern borrower? Mark, maybe we'll go back to you.
I don't know what that means. Look, I think we are moving to 7/24, real-time, mobile-first experience. And I think our bet, by the way, is while we've seen some disaggregation of banking services now to special purpose players, I think we'll see user experiences that re-aggregate some of those into a seamless mobile experience for small businesses that wrap not only lending with other value-added services. I think that's an interesting vector that we see.
Yeah, I think it's digitization, immediacy. The user will be getting their loans in the matter of minutes, seconds the decision, but in the matter of minutes they will get the loans that they need. But there is also another layer on top. It's like once they stay connected to the businesses, the thing is that you can even forecast the needs, right? So you can predict that they will need some money, and then you can even anticipate. You can make an offer before even they get to that point, and so it becomes more of a very close relationship, personalized relationship with your lender and your lendee.
So I'm not trying to get myself fired here. Wealth is actually a better predictor of the future ability for someone to repay their debts than traditional historic credit data. Now, obviously, the combination of those two things probably has more value, just put it out there. So I think it's really interesting when you start to hear things like open banking and kind of the ability for whether it's small business owners to be able to share some of that wealth information or indeed use alternative data to get access to wealth data. I think that's going to become more inherent in our traditional credit models going forward.
Yeah, I mean, my take is things will move faster, mistakes will be made. Regulators will overreact in some places, underreact in other places. But really thinking very long term, things like open banking, even going beyond that, imagine we're in a world of like open life where you can seamlessly pull all relevant data at the point of interaction. When it comes to customization, there is like an uncanny valley of creepiness. And so we have to start being mindful of these things. And I think the conversation is going to move a lot more in the direction of informed consent when we get to scalable automated systems.
Perfect. Great, a lot to look forward to. Well, thank you so much to our panelists for the insightful dialogue. And
we have a few minutes,
sure.
and folks can ask questions to Mark as well. Based on, let's open up for a few minutes.
okay, so if anyone didn't catch that, Gary asked if there's any Q&A in the audience. Oh,
Can we talk about Plaid and Visa? So let's say you're a product manager at Visa, and you just bought Plaid. What are you going to do with it?
Maybe start with Rebecca.
That's a question I don't have an answer.
Can you repeat the question? Can you just repeat the question since you have the mic?
So if you're a product owner at Visa and you just bought Plaid, kind of what would be the first thing you would do? I don't have a good answer for that. I don't know what the time is.
So I'm actually thrilled that Visa bought Plaid. I know that Plaid is thrilled that Visa bought Plaid, but I'm thrilled that Visa bought Plaid for a couple of reasons. One, I think Visa has demonstrated an ability to generally protect people's data. I think the banks will feel more comfortable having a steward like that on that data. I think open banking is a given. Why did they buy it? I think Visa is turning itself into a platform company, and that they would like to power the rails of future fintech as much as anything else. So I think that's my guess as to why they bought it.
I'll just ask, is anyone from Flinks here?
Is anybody from Flinks here?
I was just going to see if you wanted to comment.
They probably know better.
Exactly. They're hoping the MasterCard buys them here.
Yeah.
Hey guys, great panel. Thank you very much. I had a question about the C of credit, the character, because as things keep going faster and faster and faster, the thing that gets lost is measuring the character of a borrower. I wanted to know if there's any interest in getting more information on things like HR or management of the team or operations and how people handle internal production or sales processes, things like that.
I mean, I can comment on the consumer lending side. I know you probably have more of a business mind on that. So, I mean, on the consumer side, at least, character is probably what we're trying to infer with incorporating social data. And so there's a ton of risk there, especially with the volatility and just questions on, you know, how legal is this? Because that could easily start tripping the territorial proxying protected statuses. But I'll turn it over to someone else for business commentary.
So it's a good question. It's hard to ascertain typically, but here's how we think about it. If you're a B2C business, your character as a business is probably defined by the social sentiment around your business. So for example, if we looked at your OpenTable, Yelp, Trustpilot, Google reviews, and we saw an increase in the number of reviews and an increase in the quality of reviews, we'd feel better about your business than if we saw a decrease in the number of reviews and a decrease in the quality of the reviews, right? So that's a way of judging not the character of a business, but whether you're serving customers or not. Will we take that stuff into account in our models? Yes. To what extent will they drive our models? I can't tell you yet, I don't know. But yes, we will judge that. Would we ever look, for example, at Glassdoor profiles of a company and use that to infer the quality of management, or look at people's LinkedIn profiles as founders and see how much they've hopped around? Maybe, I don't know yet. That's undiscovered country.
Just have one final question.
Yeah, so my question is about asymmetrical data between startups and larger companies such as Amazon or Visa. Where do you see the competitive advantages of startups compared to these larger companies who have a much broader data set? Because in the end, it's down to, you know, how much data you have access to and the quality of your credit models. So besides competing on the quality of your credit models, how do you see startups, you know, competing against larger companies in that space?
Go ahead.
It's a very good question. I think about it every day. So I'm going to hedge my answer by saying basically, if I have the ball and I want to run up the field, am I going to run into the crowd of defenders, or am I going to try and avoid them? I think competing against them on their terms is going to be very difficult. I would flip the opportunity in a different way and say there are a lot of companies in the long tail of e-commerce, payment service providers, and so on, who are looking jealously at Amazon and Square and PayPal and Stripe and so on and saying, wow, it's sort of a little irritating that they get to monetize their customers and increase, you know, the effect on their business by unlocking credit. Wouldn't it be nice if we could do the same thing? So we do think there's an opportunity for credit as a service to serve the long tail of competitors to those businesses, and in that way find the white space up the field.
And speed and capabilities are going to be a huge differentiator. That's a big disadvantage the incumbents have. They run on some pretty antiquated stuff. I don't know if there's any COBOL programmers in here, but anyways, even if they wanted to get insight into market, it could take you know, a year to operationalize that data set, and then maybe even another 6 months to actually deploy it on their antiquated systems. So this is a pain I really felt until recently we kind of overhauled our tech stack. But that's an advantage that the new companies that are kind of born in the cloud will always have.
I think there's also some advantages again back on the people side, which is, you know, your startups, your fintechs. A lot of, you know, data scientists and those sorts of people, they kind of want to work with a cool company, and they kind of quite like working for fintech with some open spaces. And I know Google and Amazon kind of have that sort of environment, but actually they're so big now, it's almost at risk of being sidelined into kind of a silo within those large companies, whereas in fintech you get that breadth of experience. So I do think there is some opportunities for them to kind of grab some of the best talent that's out there, just because by nature they actually are kind of small and more people into that generation.
Sorry.
Yeah, the other thing is that fintechs and startups are a lot more dynamic. Like, you know, you just you put something out there, you make mistakes, you fix them. You're just evolving faster, I will say. Like, of course, the data is a big difference between what those guys have on the small startups, but then you beat them and be more dynamic. I think that's the way.
Just add one more thing too, and that is that not all, so there's 2 points of unfairness with these guys, right? One point is they have data and they have customers just sitting there, and they have a business model that has hungry customers. Like, that's one issue. The second issue is they don't have to make money on the loan, right? Because it really isn't the primary business. In a way, it's fuel for something else. So they can actually lose money on the loan if they need to, because they're going to make it margin on somewhere else. That's an unfair playing field. So I would rather not play against that playing field at all, to be honest. However, what I would say is that the world is not dominated solely by a handful of the 4 horsemen, right? There's significant business happening elsewhere. And what you learn from the 4 horsemen is the power of proprietary data. But proprietary data is available all over the place. And so as startups, I think it's our job to go find it and scale it and operationalize it. I don't want to compete with Capital One. That's not a winning value proposition.
I'm sorry, we just have one final question.
Yes, very quick question, thank you. We talked a lot about the data analytics and how it relates to the lending community and different lenders in the field and even the people that are involved in the industry. But what about the end consumer? And I'm curious from the panel to hear why should small business owners and business owners out there be excited about advancements in data analytics in Canada, and what impact will this make on this community that there's a consensus is being underserved right now?
So from my side on the data analytics side, it's really about personalization, I think. I think as you make advancements in this field, it gives the opportunity to have the ability to tailor products to actually that small business needs. So it's really around how you can engage with them, how you can make sure you're having the right offerings for them. And that kind of personalization, I guess, grows loyalty, and loyalty ultimately grows growth for the lenders as well. So I think it's a win-win.
Stay tuned for a product called Float Simple, launching in hopefully the 3rd quarter.
Wonderful. Big round of applause for our panelists.